Welcome to my rapidly growing YouTube channel. I'll be walking you through some 9 investing mistakes the ultra-rich avoid. For a chance to win a $50 gift card, please subscribe to my channel, hit the like button, and leave a comment below. People who have a net worth of at least $35 million are considered ultra-wealthy. Shares in private and public firms, real estate, and personal investments make up the majority of these people's net worth. Many people with lower net worth assume that the key to becoming ultra-wealthy rests in some hidden investment technique when they look at these high net worth individuals. This is not always the case, however. Instead, wealthy people understand the fundamentals of making their money work for them and how to take measured risks. The first rule of investing is to avoid making a loss. The ultra-rich aren't mystics, and they don't have any hidden investment secrets. Instead, they know how to avoid common financial pitfalls. Many of these blunders are well known, even among investors who aren't extremely affluent. The following is a list of the most common investing blunders that ultra-wealthy people avoid. Number 1. Only investing in intangible assets. Stocks and bonds are usually the first things that come to mind when people think of investing and investment strategies. This isn't to say that these types of investments are always the greatest. It could be due to increased liquidity or a lower entrance price. Instead, the ultra-rich recognize the worth of tangible goods and manage their funds accordingly. Private and commercial real estate, land, and gold are among the things that ultra-wealthy people invest in. To balance out the volatility of stocks, real estate remains a popular asset type in their portfolios. While it is crucial to invest in these physical assets, the lack of liquidity and higher investment price point typically deter smaller investors. The super wealthy, on the other hand, believe that owning illiquid assets, particularly those that are uncorrelated with the market, is good to any investment portfolio. These investments are less sensitive to market fluctuations and pay off in the long run. Number 2. Only investing in mature markets. While industrialized countries such as the United States and the European Union are regarded to offer the best investment security, ultra-wealthy individuals look beyond their borders to frontier and emerging markets. Brazil, Chile, Indonesia, and Singapore are among the top countries where the ultra-rich are investing. Individual investors should, of course, conduct their own research on emerging markets and determine whether they are a good fit for their portfolios and overall investment plans. Number 3. Failure to implement a saving strategy. The financial plan of ultra-wealthy people always includes their saving strategy. The ultra-wealthy recognize the need of prudent investing combined with a prudent saving strategy. They live within their means, keep their debt under control, and save enough money. Wealthy people recognize that a financial strategy is a two-pronged approach. They invest properly and save smartly. As a result, the ultra-rich can concentrate on growing cash inflows while decreasing cash outflows, hence increasing overall wealth. While it's not customary to think of the ultra-rich as savers, they understand that living within their means allows them to acquire their desired level of wealth in a shorter period of time. Number 4. Investing solely in the public markets. Because public firm shares are readily available for purchase through brokerages or retirement investment programs, most everyday investors prefer to invest in them. Selling stock on a public exchange is simple because it can be done on the same day as a choice is made. High net worth individuals, on the other hand, recognize that true wealth is created in private markets rather than public or common markets. The ultra-rich may have amassed a large portion of their money through private firms, either as owners or as angel investors in private equity. One of the most significant contrasts between private and public corporations is that private equity investors are often compensated in the form of distributions rather than stock accumulation. Typically, private equity investors receive distributions during the course of their investment. Some private companies may have the potential to go public in the future, giving investors and shareholders a higher return when they do. There is also a chance that those private enterprises will be bought up by larger corporations, resulting in a substantial profit for shareholders. Number 5. Following investment trends. The risks of chasing financial trends are well known among the ultra-rich. Instead, they conduct their homework before determining where to put their money. They also make investments when they are confident in the market. Rather than speculating on short-term gains, they are more inclined to invest for the long term. Whether it is indulging in a frenzy over GameStop stock, as we all saw many months ago, or investing in the newest cryptocurrency, pursuing trends is a typical mistake that the very affluent avoid. The average investor frequently follows the next hot stock without knowing why they chose it other than someone else said it was fantastic. Because they are afraid of missing out, some investors make the mistake of chasing trends or what's popular. Wealthy people, on the other hand, always do their homework before investing their money. Number 6. Keeping up with the Joneses. Many smaller investors are constantly observing what their counterparts are doing and attempting to duplicate or outperform their tactics. However, staying out of this form of rivalry is essential for accumulating personal wealth. The ultra-rich are aware of this, and before making investment decisions, they set personal investment goals and long-term investment strategies. Individuals with a high net worth envision themselves in 10 years, 20 years, and beyond. And they stick to a financial plan that will get them there. Rather than trying to keep up with the competition or growing fearful of the impending economic slump, they stick to their principles. Furthermore, the ultra-rich excel at avoiding comparing their fortune to that of others. Many people who aren't wealthy fall into this trap. High net worth individuals resist the temptation to acquire luxury items just because their neighbors are doing so. Instead, they invest the money they have to increase the value of their investments. They can then cash out and buy the toys they want once they've reached their chosen level of riches. Number 7. Failing to rebalance a personal portfolio. Although financial literacy is a major issue in the United States, everyone should be aware of the need of rebalancing their portfolios. Investors can ensure that their portfolios are appropriately diversified and proportionally allocated by rebalancing on a regular basis. Even if some investors have stated allocation targets, they frequently fail to rebalance their portfolios, leading them to swing too much one way or the other. Based on a person's age and risk tolerance, a balanced portfolio typically comprises the correct combination of cash, equities, and bonds. Rebalancing is a must for the ultra-wealthy. They can rebalance their portfolios monthly, weekly, or even daily, but all high net worth individuals do so on a regular basis. It is feasible to create rebalancing parameters with investment businesses based on asset prices for those who don't have the time or the money to hire someone to do it. Number 8. Neglecting personal investment objectives. High net worth individuals recognize the importance of establishing personal investment goals and sticking to them over time. This means they stick to their guns and stay invested even when markets experience a slump. They aren't tempted to liquidate their assets in order to buy the next must-have thing. Instead, they recognize the value of compound interest. Number 9. Mixing emotion with investment. High net worth individuals recognize the need of removing emotion from investment decisions. They don't make snap decisions, but they also don't stay invested in a company whose core fundamentals have altered. They don't let fear or greed dictate their actions, and they recognize the importance of patience. They never watch the markets incessantly or respond emotionally to market changes. Instead, they keep their investments for as long as possible to maximize their profits. Finally, as even Warren Buffett can admit, making mistakes is an inevitable part of the investing process. Knowing what they are and avoiding them as much as possible, on the other hand, will reduce your investment failures. The lesson here is that you don't need millions of dollars to secure your money in the market. I hope you'll find these ideas helpful. For a chance to win a $50 gift card, subscribe to my channel, like the video, and comment. Bye for now.